So should you invest in stocks or property? Let's grab a coffee and get right into it. So in this video, I'm going to talk through the pros and cons of both property investing and stocks. So as you can see, I've got lots of scribbles here on my notepad that I want to try my best to articulate. And then I'll round up by giving my personal opinion, and I'll also talk you through what I'm doing right now. So that'll be a brief overview of my personal investment plan. Okay, so let's start off by analyzing property. So with property investing or real estate, you'll generally see higher returns. It's also maybe it could be perceived to be safer. Another bonus is that you get much more control over the investment. You have personal input on what happens with the investment. However, the major downside is that it has much higher startup costs. You're probably looking at least £20,000 in the UK. However, you do get paid twice, so once in terms of rental income and the other one in terms of capital appreciation. So on the note of the rent, so that's monthly, that's a consistent monthly income that you're going to see. However, a negative could be that you don't actually see that rent because the tenant doesn't pay. However, you don't have to deal with tenants if you don't want to. You can offload this task to letting agents. Personally, I'd recommend doing that, especially if you're just starting out. So back to tenants, yes, they could wreck your property, but let's be honest, that's pretty unlikely. So you could consider property investments to be safer because that brick and mortar is always going to be there. As long as there's rental demand in the town that you bought the property, then you should be okay. So one big benefit of property is that you can use leverage. That'll be in the form of a mortgage. Normally for a buy-to-let mortgage, you'll be looking at 75% loan to value. So that means you're going to need a 25% deposit. So in the stock world, using leverage could be perceived to be risky, but when it comes to property investment, mortgages are commonplace and are not perceived to be risky. So it's important to mention some of the other costs involved with getting into property investment. So when you purchase a property, you're going to have legal fees, a mortgage fee, and a broker fee. You may also have fees to pay for any surveys, and it's quite likely that you might at least have some small refurbishment costs. Then once your property is ready to let out, you're also probably going to have letting fees. And then once you let out the property, you're probably going to have some maintenance fees. It's a good idea to keep some of your rent aside for that. So that covers the cost when you buy a property. What about when you sell it? Well, you're going to see lots of fees again, things like solicitors and estate agents. So as you can probably tell by now, property is a people business. You need to speak to lots of people. And it's possible right at the start that you're probably going to be chasing tradesmen. So yeah, if you want to invest in property, then you really can't be hiding under a rock. So one of the major cons with property investment is the liquidity. So what I mean by this is that sales can be quite slow. And it's possible that depending on which area you buy in, the property could be on the market for a long time. If you compare liquidity between property and stocks, they're really just on opposite ends of the scale. So now let's talk about the dreaded issue of tax. So taxes are quite high on property investments. If you decide to invest in property in your personal name, then you cannot claim the mortgage expense as a tax deductible expense. So investing in property in a limited company means that you pay corporation tax rather than income tax on any profits earned. This is because when extracting profits from the business, you take it as a dividend. Dividend tax varies on your income tax band, but this is generally a more efficient way of extracting profits. Of course, I'm not qualified to give tax advice, so make sure that you seek independent advice. The other thing you're going to need to think about is capital gains tax. So this is tax that you'd pay on any increase in the value of the property. So if you bought a property for 100,000 and it went up to 120,000, then you might pay 28% tax on that £20,000 increase. Note this doesn't apply if the property is your primary residence. Due to principal private residence relief, you'll pay zero tax on your own home. Now this final point is one of the most exciting things about investing in property. It's possible to find property under its market value and force appreciation. Basically, you find a fixer-upper, renovate it, and in doing so, you add value. And if you add enough value, it may be possible to refinance the property and extract some of your initial deposit. Now, moving on to stocks, it's easy to get started and you need low initial capital. In terms of cons, you're probably going to see smaller returns. So where you might see 20% return on investment with property, you're probably only going to see 5 to 8% with stocks. With stocks on a good year, you might see that 20% return that you can get with property. With stocks, there's generally a trade-off between if you want to buy a stock for dividend income or for growth potential. Note, the same usually goes for property. You either buy it for its annual yield or its growth potential. So I guess one big plus for stocks is you can literally do it sitting on your phone on your sofa. The barrier to entry is very low and you literally don't have to speak to anyone. And like I said before, there's high liquidity, so as long as the market's open, you can instantly buy and sell. And if you're unsure or just want to dip your toe in the water, you can start with a practice account or maybe a small account, maybe less than £1,000. This will give you the opportunity to learn how the markets work and how to manage risk. When buying stocks, the fees tend to be simpler and often you can get fee-free trading. Speaking of which, if you check the description, I have referral links to Trading 212 and Free Trade. If you sign up using my referral link, you'll get a free stock worth up to £100. Now back to the issue of tax, you still have to pay capital gains tax on profits you make on stocks. However, there is a way around this. Use a stocks and shares ISA. Both Trading 212 and Free Trade offer stocks and shares ISAs. So yeah, if you use a stocks and shares ISA, you won't need to pay capital gains tax. If you want to see a step-by-step video on how to set up a stocks and shares ISA, then let me know in the comments. So I spoke about using leverage in the form of a mortgage from buying property. Well, leverage also exists for when you buy stocks. In the stock world, leverage is normally known as margin, and it allows you to buy more of the stock than you can really afford. So if you were to use 6 times margin, for every 1 stock that you buy, your broker would allow you to buy another 5. This means that if the stock that you buy goes up in value by 10%, then you'd actually see 6 times that profit. It's also not uncommon to see margin of 400% in the foreign exchange world. So I pointed out how margin can increase your profits, but equally it can amplify your losses. And if you get what's known as a margin call, your entire investment could be wiped out. So with that in mind, I advise against never using margin. For retail investors, it just doesn't make sense. If you're enjoying the video so far, I'd like to ask you to hit the like button. And I've got lots more in the works that I can't wait to share with you, so it'd be greatly appreciated if you could hit subscribe as well. So to round up the video, I'd like to point out that neither of these investment opportunities are passive. You might have been led to believe that one or the other or both are in fact passive. When it comes to stocks, they could be overbought or oversold, and you can't just guess and buy whatever you like the look of. If you're doing it right, lots of research will be involved, even just to figure out what the best time to buy and sell is. However, at the end of the day, the old saying, time in the market is better than timing the market, is always true. However, you do always still need to keep an eye on your stocks. It's possible, if unlikely, that they could go to zero. When it comes to property, there's lots of time spent up front educating yourself. Just like when you select a stock, a lot of the work when buying a property is done up front. This is usually when finding the property and then dealing with estate agents and lawyers and such. And if you have a refurb, that'll take up a lot of time, even if you're not getting hands-on. Although once all this upfront work is done, you can hand off the property. And from this point, it is generally quite passive. As long as you have a good letting agent, you're not needed for the day-to-day running of the property. However, you're still probably going to want to come back to it occasionally. Checking up on your investment is important, and you may want to sell it in the future. You may also have to deal with remortgages and things like insurance. And it's possible that if the property requires a major refurbishment in future, you might also have to deal with that. So neither of these investments are completely passive, but equally, neither of them is a full-time job. At the end of the day, I think it's all personal preference. Maybe one of them excites you much more than the other. I have investments in both stocks and property, but for me right now, due to my age, my net worth, and where I am with my career progression, it doesn't make as much sense for me to go heavy into investing in stocks. So for me right now, I'm focused on property investing, and I'm using 50% of my take-home income and putting it towards property. I do a few £1,000 in stocks, but I see this as more of a hobby or an interest type thing. And also to get the ball rolling for future. You may already know how powerful compounding interest can be. Saving a couple of £100 a month can turn into over £1 million over 4 years or so. So make sure to sign up to those trading apps, even if you decide, like me, not to go heavy on buying stocks right now. And don't forget to also take advantage of the stocks and shares ISA. So that about wraps up this video. If you've learned something new or you enjoyed the video, then make sure to hit like. It's really appreciated. It's also greatly appreciated if you subscribe as well. And let me know in the comments what free stock you got when you signed up to Trading 212 and Free Trade. And also let me know what new video topics you'd like me to cover. Thanks so much for watching. I'll catch you next week. Oh, it's gone cold.